If you don't want to allocate capital to stocks because of the reasons we've mentioned, and you don't want to allocate capital to real estate because of the reasons we've mentioned, and you don't want to keep your capital in the bank because, the reasons we've mentioned, then you've run out of a lot of options there.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're glad to have this returning guest. Sam Lawrie joins us. He's the partner of Australian economist John Adams, who you know well. He works with Adams Economics. He has a history in both equity analysis and also derivatives trading and some algorithmic trading as well. Sam, thanks for coming back on Liberty and Finance.
Thanks for having me again, Donegan. It's great to be here with you today.
You are a student of many aspects of the financial world, and we wanted to probe your understanding of current trends in some key areas that people are watching. Perhaps what we should do is start off with something that really shook up a lot of folks over the past week, and that was the American CPI, Consumer Price Index, numbers coming in hotter than at least the leaders were willing to admit the week before that, and it caused a spike in the 10-year yield. It caused a drop in stock markets. It caused a drop in metals, and a lot of bargain shopping on the part of retail bullion investors, that sort of thing. Can you give us your view of what the real picture is around inflation and the trend that that's taking, and what the likely policy response is going to be going forward to that trend, and why that matters to those who are wanting to position themselves correctly to take good care of their families going forward?
Absolutely. What a place to start. So, yes, a few days ago now, we saw some hotter than expected inflation data come out of the US. Now, the market's response to that data was essentially that the rate cuts that everyone's been waiting on, that Jerome Powell started talking about in December, that they're going to be delayed, that, with inflation hotter, we've got to keep rates higher for longer, et cetera, et cetera. Hence why, the 10-year bond yield jumped, the DXY, the US dollar index jumped as well. And then precious metals were under pressure from that move as a currency move there. Now, precious metals have rebounded strongly since that initial drop, which is fantastic for us. And it's something where I look at it, and when you see precious metals sell off on the back of high inflation, despite precious metals being a hedge against inflation, it's quite counterintuitive. You think, well, how does that work? And then now we've seen the market rebound. So it's interesting thinking about inflation expectations and interest rate policy moving forward. And something I think is poignant to point out as well with this whole interest rate debate or conversation is that if they do hold rates high for longer, then the debt burden becomes even worse or closer to unpayable. So the US has almost $10 trillion of debt maturing in 2024. So if this higher inflation data persists for a while and the Fed has to hold rates higher for a while longer, then all that debt rolls over at significantly higher interest rates than it was initially financed at. So, your interest cost on servicing the national debt just continues to skyrocket. I mean, a couple of years ago, it was less than $500 billion a year, and now we're approaching $1 trillion a year. So just in interest repayments, it's quite scary. And, that's approaching the size of the military spending for the US government, which is your largest budget item. So it's quite worrying to think about the long-term consequences of holding interest rates relatively high with such a high debt load. And that's I suppose where the entire my metals thesis comes from, is that, well, if inflation is getting worse, and I can step out why I think that's the case, and interest rates cannot be raised high enough to fight inflation. They can't pull a Paul Volcker and raise rates to 15% when they're $34 trillion in debt. Then that long-term big picture thinking comes in of, well, how do I get out in front of this? And that's where gold and silver come in my mind. So yeah, it's interesting as well watching the flip-flopping from Jerome Powell on interest rates. I mean, for the last couple of years, we've seen interest rates being raised at the fastest rate in history, which, for a lot of people was unexpected. For some people, it was absolutely expected, given the amount of money printed, or currency printed, should I say. And then, in December, Jerome Powell seemingly out of nowhere comes out and says, hey guys, we're gonna lower rates, we're gonna cut rates next year. And then the US stock market, of course, just rallied incredibly strongly off that news. Tail end of last year, even the first month or so of this year, you look at stocks like Nvidia, which, that chart just looks parabolic. It reminds me of the 2000 tech bubble. So, that's kind of where we've come from. In the last meeting or so, we've seen talks of holding rates higher for longer. Again, this hot inflation data helps support that narrative, helps throw water onto the idea of rate cuts, at least immediately, which then has me thinking, well, the stock market is incredibly elevated because of said rally, and anticipating rate cuts. It's quite overextended. It has a lot of potential for downside here. And then with precious metals, we've been trading sideways essentially for a few years in the face of rapidly increasing interest rates. So if interest rates were to turn around, particularly with inflation being as high as it is, that could be awesome for precious. Expect to happen. I year for precious metals because of interest rate policy and everything that the Federal Reserve has to do. So yeah, interesting times to be watching the Fed.
Now, the Fed has also been engaged in some fancy footwork to prevent liquidity and, frankly, solvency problems for major banks, etc. The Bank Term Funding Program was rolled out almost a year ago, and remarkably, this is the kind of thing that never happens to ordinary individuals and ordinary households. It's like, okay, you bought something, it's now worth a fraction of what you bought it for because with interest rates having risen, their bond portfolios were destroyed, and yet the Fed says, don't worry, we know we're causing all kinds of wreckage with this, like Volcker did with where he's raising rates, but instead of taking the heat, we're going to just take the burden off of you and put it on ourselves here. Go ahead, give us your destroyed bond portfolios, and we'll count them at full value, and come back later, and you can pay us back later. So the banks end up looking less insolvent than they otherwise would have. And we saw 3 bank failures in first quarter and second quarter of last year, the second, third, and fourth largest bank failures ever in the history of the United States. There have been a handful of smaller bank failures so far since then, but it seemed like that splash bucket of liquidity and basically bailing out these banks to make them look solvent on their balance sheets has forestalled what could have been a banking crisis and maybe bought some time. There's been a lot of concern. We've had other analysts on who are money managers also, who watch the fact that the Bank Term Funding Program is set to end in about 3 weeks from now, and like March 11th, and not be renewed, supposedly. And so what's your view of whether that is going to, cause basically a crisis moment for these banks, which really are insolvent, but it's been covered over with this temporary Band-Aid for the past year, which is about to end?
Absolutely. I look at the Bank Term Funding Program ending, and to me, watching markets climb in the face of higher rates for the last, ever since the 2022 bottom, I've thought, well, how does that happen? And the answer is programs like the Bank Term Funding Program, where, like you're saying, these banks with huge unrealized losses from their asset portfolios. If you look at US Treasury bonds over the last couple of years, they're down, around 50%. Imagine if you're a bank and you sat on a huge portfolio of US Treasury bonds and, mortgage-backed securities, all of that's been locked in at very, very low interest rates. And, now they're down significantly because interest rates are up, prices being inversely correlated to rates there. And then on the other side of it is your liabilities, where your depositors, you're having to pay them higher and higher interest rates to maintain their cash in your institution. Otherwise, they'll just take it somewhere else. The beauty of free markets and competition. So, there's that whole issue for banks to face. And recently we've seen New York Community Bank start to have some issues there. I believe they bought out Signature Bank back in the day when they were having issues. So, analysts out there are saying that the regional banking crisis could be back on again. Could be a little bit too early to tell for sure, but it does certainly look worrying. And particularly, like you're saying, with the end of the bank term funding program in early to mid-March there, that's not very far away, and it is quite worrying because if the bank term funding program has given the system the liquidity it needs to paper over these huge unrealized losses, which I absolutely think it has, and it's allowed the US banking system to continue limping on, then the removal of that program could spell trouble. Now, that's not to say that they couldn't kick the can down the line with another new invented program and all of that, but even still, every kick of this can is inflationary. It involves printing money out of thin air and handing it to the people that need it so they don't go bankrupt. So all of that feeds into the thesis of why you need to protect yourself from inflation.
There's also been a lot of going on and a lot of concern about the prices of energy. We haven't even talked yet about the BRICS, the East-West split, but it seems like the world is dividing and taking up sides between those who have energy resources, other strategic materials and commodities and so on, and those who have relied on, I guess, force typically, and alliances and that sort of thing based on force to engineer this house of cards that we have of a fiat currency system and derivatives built on top of it and so on. There was just a statement that came out in the last day here from a Federal Reserve president saying that the U.S. dollar will remain the Federal Reserve currency when the Fed will defend it. And that seems to come in response to growing awareness that Russia, China, and others are in fact moving forward, pivoting away from the U.S. dollar. And a big chess piece in that move has to do with oil, has to do with energy. And the petrodollar, as established by Henry Kissinger in the second half of the 20th century, has been an underpinning of the prolongation of the world reserve currency status of the U.S. dollar, which is getting very long in the tooth, 80 plus years since Bretton Woods or 80 years since Bretton Woods in 1944. So your view of major factors that have been and will be affecting the price of oil and the balance of power associated with that in the next this year and beyond.
Absolutely. So there's a few things to talk about the oil market in the past, and then I'll move to the future. So first of all, if you look at the oil price over the last few years, it's been very volatile. In the COVID lows, it went negative. It hit $130 a barrel when Russia and the whole Ukraine thing kicked off there, and then we've seen the US unload their strategic petroleum reserve onto the market to drop prices from 130 down to 70 or so. We're back up at around $78 a barrel or so today, and it seems to be supported there by the 200-week moving average. But it's something to watch moving forward. I'm very bullish on oil moving forward. There's a few things I'm watching that make me particularly bullish. I mean, one of which is the current Chinese stimulus packages being unloaded at the moment. So, printing hundreds of billions of dollars out of thin air, lowering reserve ratio requirements at commercial banks, banning short selling of Chinese stocks by their large financial institutions. There's a few things going on in China to be watching at the moment. Their share market has been on the decline, significant decline for months and months now. So that's something to be watching there. China having 1.5 billion people, being the world's manufacturing hub, it is a very important economy to watch. So that's one I guess driver of demand for oil moving forward. And the second big driver in my mind as well actually comes from India. So I look at India as a quite agricultural country. It is industrializing. Its cities are growing quite quickly, and its infrastructure as well. So I look at a country that doesn't use much oil. If you look at their population, quite a low percentage of it owns cars. Lots of their population lives rurally, disconnected from internet and, a lot of the times electricity as well. So essentially what I'm saying there is huge room for growth for India throughout their industrialization, and therefore a huge room for growth in the demand for oil for said industrialization. If you expect Indians to be buying more cars and using cars for the first time, a lot of them, then that's oil has to come from somewhere for that. So for those two reasons, as well as a few others, the conflict in the Middle East, the pressure that adds to the oil price, I am very bullish oil moving forward, and the effects of that flow onto the whole commodity space in general, and precious metals more specifically. So when you look at oil, it's the world's largest commodity market, and particularly in developed economies like the US or Australia, we're very oil dependent. For logistics, for pretty much everything, we use a lot of energy. We're very energy intensive economies. So you can't forget the importance of oil here, and bringing it across to the rest of the commodity sector more broadly. Even when it comes to food, the production of food requires oil. Farmers drive tractors and et cetera, et cetera, et cetera. So it's used everywhere. For mining, the diesel that the trucks use to pull stuff out of the ground and ship it to the refineries and everything. It's very energy intensive. So yeah, if you see the price of oil moving up considerably like I do, then the price of producing commodities in general moves up considerably, and therefore the price of those commodities moves up considerably as well. And something that I think is an interesting thing to think about there is that people talk about commodity super cycles, which I absolutely believe in, and a lot of that comes from different commodity prices feeding into each other. So, an increased price of oil means an increased cost of farming and this and that, and, an increased cost of pulling iron ore out of the ground. And that increase in the cost of iron ore means an increase in the price of this commodity that, it's all linked. Everything's connected. So, talking about the biggest commodity market in the world, oil, if you're particularly bullish on that, then the rest of the commodity super cycle starts to make even more sense to you.
And how does that play out, not just from an investment thesis, but in terms of affecting this power standoff that's forming between Western nations versus the BRICS nations, in your view?
What a question. So when it comes to the commodity super cycle, countries that are commodity producers, countries like Brazil, Russia, Saudi Arabia, even China, the world's largest gold miner, countries like that are set to do very well in a commodity super cycle environment, whereas countries that don't produce commodities, broadly speaking, you look at the European Union, a lot of those countries don't produce many commodities at all, and they're quite large consumers of commodities. Countries like that are set to do very badly from it. So, talking about incentives for a second, if countries, across the West are broadly speaking incentivized to like lower commodity prices, and countries across the East are broadly speaking incentivized to like higher commodity prices, then you've got a standoff there between two broad sections of the world that are incentivized to like different commodity prices. So it makes you think that if you're in a Western country and your population would prefer lower commodity prices, then of course you see Western governments and financial institutions trying to manipulate commodity prices lower. And then, Eastern countries, they would obviously like commodity prices to be priced fairly. Of course, as precious metals people, we would love a fair gold price or a fair silver price, one that's not manipulated. But it's not just us. You look at the Saudis, and they've talked about, in the past year or two, that they would like to see a fairer oil price, an oil price that's more reflective of, the fundamentals around the world. So it's fascinating. There's a definite standoff there between commodity producers and commodity consumers, and the political consequences of that moving forward will be interesting to watch, to say the least.
We've also got you mentioned earlier this bubble of valuation in the U.S. stock market following Powell's commitment to cut rates and during the COVID crisis and pumping out unprecedented amounts of new currency. So you had that combination of low interest rates and more currency than there's ever been awash. And one of the results of that has been this bubble in the stock market, which has been a bit volatile recently. But what do you see forward in terms of stock market valuations and also market internals? Because we've had a professional money manager on talking to us about that it's very misleading and for most people who just watch the headline statistics of the Dow Jones average or that sort of thing that's just talked about every night on the evening news, thinking that the stock market's doing well, that must mean the economy is doing well, that must mean the country is doing well, that must mean they should just keep listening to their traditional financial advisor who's been telling them for 40 years to just stay invested in the market and buy the dips and you'll be just fine. Make 7 to 10% per year on average. And what do you think is the truth that people need to be aware of about what's actually going on in the market, and if they really want to take care of their family, what they need to be thinking about that they're not being told?
Yes. Well, first of all, the first thing I'll speak on about the current US stock market here is that, yes, it has set all-time highs in nominal terms recently, hence why, like you say, the mainstream media is coming out and saying, stocks are great, buy loads of stocks, they'll keep going up forever. So, you can understand where that sentiment is coming from, but I believe it is misguided. So, first of all, is that nominal high is not a real high. In 2021, $100 went a lot further than $100 goes today. So that's something to consider there, is that even though we are at nominal new highs, we're not at real new highs yet. So it's a bit early to be, claiming victory, I guess is what to say there. And beyond just that, there's things happening under the surface in the stock market. So if you look at this rally, the concentration in names here, the Magnificent Seven, Facebook, Apple, Google, etc., most of the gains in the stock market today come from those Magnificent Seven companies. You look at the small caps, the Russell, it's lagging the large caps, and particularly the tech sector, by a long way. So this isn't a fully fledged stock bull market. This is a highly concentrated, mainly tech sector run in stocks. And, I mentioned a little bit earlier NVIDIA. I plead with your listeners, just have a look at the NVIDIA stock price. It is insane, that chart. It looks like the 2000 tech bubble all over again. So, when you're seeing a massive stock market rally off the back of Jerome Powell's, December address saying, hey, we're going to cut rates in 2024. And, the market is pricing in rate cuts. It's pricing in almost a 1% rate cut over the space of the year, back down to 4% again. That is technically speaking bullish for stocks, but that run's arguably already happened. If you bought in December based on Jerome Powell saying we're going to cut rates, and you've ridden the ride, well, it's been a good ride already. So has that been priced into the markets? I argue that it already has, and hence why we're seeing the markets start to come off as they talk about that higher inflation read and keeping rates higher for a little bit longer. So I see a lot of potential for downside in the stock market. Not to say it'll happen tomorrow, but I do see a lot of potential for downside there. So if you're allocating capital today and you're looking at stocks and maybe you're trying to chase the run here, it may be a little bit late to get in, is I guess what I'm saying there. And, particularly stocks like NVIDIA, yes, that chart, if you had ridden NVIDIA for the last 2 years, you would be cheering. But is today the day to buy, or is today the day to be taking profits? So, that's what to consider there. I look at the US stock market as incredibly overextended at the moment. Again, it could keep going. That's the nature of bubbles, is that they make fools out of bears and bulls both. Bears on the way up and bulls on the way down. So I'm not saying, short it all today, but I'm saying that you look at price to earnings ratios, they are insane. Look at NVIDIA, it begs belief. So I would look at the current stock market rally, and as I said, it's not, in real terms, it still hasn't set all-time highs. And the concentration in the rally would have me very worried about allocating capital towards it today.
Another thing that a lot of real people have to deal with is real estate, and they either own a home or would like to. We have a new generation coming on that wonders if they'll ever be able to afford a home. According to the World Economic Forum, they should expect to be happy by not owning anything. But anyway, can you talk to us about what your view of, because a lot of people are making analogies between this precarious situation we seem to find ourselves in versus right before the global financial collapse of 2007, 2008, 2009, and that one of the aspects of that global financial collapse that affected a lot of people was they lost their homes, or they found that their mortgages were underwater, that sort of thing. We've seen so far a real estate market that's showing, it had shown remarkable increases a few years ago. It's been a little bit less performing, and there's actually been some pockets of foreclosures, et cetera, happening. A lot of overhang, it seems, just like in the banking sector. It seems that there's major corporate ownership of mortgages through either major companies that have bought them up and are perhaps bought them up near highs. What is your view of the real estate market going forward? And first, maybe the big picture, and then how it boils down to how it affects ordinary people on the Main Street view.
Yeah, so look, I'm a relatively young guy here, so I completely understand all the concerns around housing affordability, people trying to get onto the real estate market for the first time. Home ownership from a social perspective is great for society. It gives people a stake in society. It's fantastic for all sorts of social reasons. But looking at the current state of the real estate market, I never thought I'd see real estate prices be as strong as they are in the face of the interest rate increases that we've seen. Here in Australia, it's even crazier. I know that in the US, your real estate market has been relatively stable over the last year or two, whereas for us, we've seen our real estate markets, particularly for cities like Sydney, just skyrocket in the face of higher interest rates. It begs belief. I know that in Australia, to give you an idea of why that's happened, it's mainly due to immigration. We've had huge immigration numbers, which has put massive demand on both houses for buying, but also, rental properties, etc. So, rents have skyrocketed here in Australia. House prices have increased moderately in most cities, but highly in Sydney and even Brisbane and Melbourne to an extent. So, it's been very interesting watching house prices climb in the face of higher interest rates. I know that over in America, it's a little bit different. You guys have, the BlackRocks and the Vanguards of the world buying up residential real estate like there's no tomorrow, often with quite cheap financing, at least compared to, what your average mum and pop investors can get their hands on. So, it's a really weird time to be looking at real estate. There's things happening that I never thought would. And talking about the social impacts of that and the impacts on the young, plenty of people my age are looking at buying their first property. This is what they're looking at. They're looking at house prices at very elevated levels. They're looking at interest rates where, the loan repayments on very elevated levels with high rates are very high. There's a lot of mortgage stress here in Australia. I think I mentioned it the last time I came on with you here that, there's a key difference as well between the Australian and American real estate markets with interest rates. Here in Australia, the vast majority of mortgages are floating rate mortgages, whereas, over in America, you get to fix it for 30 years. To Australians, that's crazy. The idea that you could have bought a house in 2020 or 2021, locked in your rate then, and then still be sitting on the same rate. Australians can't believe it almost. We have a floating rate, so when interest rates go up, everybody hurts, everyone. So that's I suppose a key difference there. What would change that moving forward? I look at the American real estate market as more prone for downside in certain ways than the Australian real estate market. We've got a tax system here that's set up to benefit real estate investors massively. We've got negative gearing. We've got concessions as well for property owners around capital gains. So, for tax reasons, the Australian government has heavily incentivised investment in real estate, and we've got immigration on our side. So over the last 2 years, Australia has imported almost 1 million people. which means that 1 in 36 Australians arrived in the last year or so. So that gives you an idea as to, how much demand our government's imported. It's similar for Canada as well. They've got similar issues to Australia. But bringing it back to the US for a second, what do I think could lead to a US housing market decline? Well, like you've said yourself, in some areas there, prices are coming off already. It is a very spotty market. Some areas going up, some areas going down. But the longer they hold rates high and the harder it becomes for people to pay their mortgages, the more likelihood there is for default or multiple defaults. And we all know what a housing crash looks like. It's lots of people defaulting all at once and having to sell all at once. So yeah, there's that on the horizon if they hold rates high for as long as they'd potentially like to.
If we could, before we close, focus on gold and silver. It's something that you at Adams Bullion specialize in, and your outlook for the role that gold and silver can play to help reduce risk. Because you've mentioned so many vectors of risk here. Bubble stock markets with terrible internals where it's concentrated in just a few tech stocks that are propping up the whole market. Banks that are actually insolvent but got papered over by a program that's about to end, et cetera, et cetera. Interest rates that everybody thought was going to be held decreasing, and now they don't know when or if that's going to happen, and inflation running hotter than expected, and conflicts and global pivots away from countries that don't have oil to those who do, et cetera. Sounds like there's risk in so many areas of our financial lives, and gold has typically served as the premier asset for a safe harbor from risk to ride out or to compensate for the effects of these crises or collapses or crashes or whatever, to help preserve people's portfolio if it's used wisely. What's your view of gold and silver right now? And as people are contemplating either getting into it for the first time or increasing their stake in the face of all of these risks that we're looking at right now?
Absolutely. So you're absolutely right there. There's a myriad of risks across almost every sector, whether it be stocks, real estate, even just keeping your money in the bank. There's real risks to be faced at every corner there. So, a safe haven asset class that is a historical inflation hedge like gold and silver, in my mind, there's no better time for it. If you don't want to allocate capital to stocks because of the reasons we've mentioned, and you don't want to allocate capital to real estate because of the reasons we've mentioned, and you don't want to keep your capital in the bank because, the reasons we've mentioned, then you've run out of a lot of options there. Even looking at it from the perspective of gold and silver, how they'll do. I mean, if they cut rates with inflation this high, inflation expectations will go through the roof in my mind. Now, one of the reasons I think that precious metals have moved sideways over the last few years is because inflation expectations have remained remarkably low, even in the face of high inflation, which is quite counterintuitive. Again, how can inflation expectations remain so low while real inflation is so high? There's almost a certain element of magic about that. It reminds you of, the man behind the curtain pulling all the levers, and everybody's just living in suspended disbelief. So, if they lower rates in the face of high inflation, precious metals will do very well. If inflation gets worse, precious metals will do very well. If there's a banking crisis collapse, precious metals will do very well. If there's a stock market decline, people will run towards safe havens. And something to think about as well, another place to be looking at, another place that people typically deploy capital is the bond markets. When the bond markets are paying you rates below real inflation, I wouldn't be looking at allocating capital there either. Particularly given the long-term outlook for government debt. $34 trillion in debt. Is it payable or not? I say it's unpayable. Okay, well, if it's unpayable, why would you buy debt? If you think that the government can never pay it off without printing insane amounts of money out of thin air to do so, why would that have you buying bonds? And if you look at traditional portfolio theory. 40% to 60% of your capital they tell you should be in bonds. If you're not putting that money into bonds, where are you putting it?
If people want to find out more about Adams Bullion, especially those viewers we have, and there are several, it's a significant number of them in Australia, because John Adams has been on our channel many times and he has a lot of local supporters there and viewers who are eager to hear from him and from you. How can they get connected with Adams Bullion?
Yeah, so on social media, we've got Instagram, Facebook, Twitter pages, so you can reach out to us there. You can also reach out to us via email. So our website, adamsbullion.com, has our email address on there. It's also got a phone number, so if you're here in Australia, feel free to give us a call. I'm more than happy to have a chat. Feel free to reach out by whatever way suits you best.
Well, Sam Lawrie, we are so grateful for your presence here with us, giving us an update on many topics related to our financial lives. And it certainly seems that 2024 and perhaps 2025 are going to be playing out to be very eventful in the financial world, because there are so many potential crises that are lined up, ready to go. And those people who don't want to just stay like deer in the headlights facing these risks unprotected are well to listen to all of the reasons that you gave us to be aware of what's really going on, because it certainly seems, especially looking at the example just most recently of this hotter than normal inflation number that came through, the leaders were telling us up to the day before that they didn't have concern, they didn't see this coming. So if we're being told that all is well, and in fact, from market internals in the stock market to on and on, banks having insolvency problems to inflation running hotter than expected, whatever that means, it sounds like we need to be looking elsewhere other than official sources to prepare ourselves accordingly. And we're grateful for your presence here as part of that. And always, on behalf of our viewers, thanks for joining us on Liberty and Finance.
Thanks for having me, Donegan. Pleasure as always in speaking to you. And looking forward to the next time we get the chance.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.